Hello and welcome to Money Matters TV. My name is Doug Hepburn, your host, and I'm of Hepburn Financial Advisors located in Phoenixville, Pennsylvania, offering securities and investment advisory services through Cetera Advisors, a broker-dealer and registered investment advisor, member FINRA SIPC. Cetera is separately owned from any other named entity. I'd like to welcome my co-host today, Ken Jordan, the branch manager from Princeton Mortgage. Ken, how are you?
Doug Hepburn, I'm doing awesome, man. It's great to see you again.
Great to see you too. You know, I know mortgage rates have been all over the place lately. Tell us about that.
I think there's a couple words I'm tired of hearing, and mortgage rates is two of them. But yeah, they've been all over the map. The upward pressure on the rates is still an issue. We've seen them bounce around anywhere between 7 and 8%, and all depending on the day, all depending on the market. What's interesting we're seeing is buyers saying, "Oh, I'm going to wait to buy because if I wait to buy, when rates come back down, the house will be more affordable." But
is that really wise?
Well, that's the question, Doug. What we're seeing right now is that it's the inventory is the issue, and right now with rates being up, there's fewer people competing for those houses, and there's still a shortage. So if rates were to come back down sometime in the near, let's say 60, 90 days, it will be great for the people who purchased over the last 6 months who have an opportunity to maybe refinance. But the people who are waiting, all they're going to do is wait when all those people get back in the market, create more competition. I think it's going to be just as crazy. So I don't know if it's wise to wait until rates come back down. I really think you should buy the house you can afford, one you can make your own, and ride it out.
That's an interesting perspective.
Yeah, and I mean, you're in the business, so you know about increase in interest rates and its effect on inflation. And tell me, where are we with inflation? I mean, I have my ideas, but where do you think we're headed? Where do you think we are?
Well, that's a great question. There's some inflation indicators that have rolled over, and the markets are projecting that long-term inflation is going to come back down closer to the Fed's target, which is 2%. But there are other analysts and forecasters who have indicated that, it may take 8 to 10 years for inflation to actually come back to a reasonable rate. So I think
is 2%
it's tough to tell.
Is 2% even possible right now, Doug?
It really depends on how you measure inflation. I mean, when you look at, for a long time, people mostly see it at the grocery store, and grocery inflation has actually come back down. But there are all these components that go into, quote, inflation. And some components of the basket go up, other ones go down, and it all evens out and gives us our average. But what's really a big part of that is, the housing. And housing is not just buying a house, it's renting a house or even an apartment. So, as you said, if people are holding off on buying until rates come down, that may be an indicator that the rate of inflation, the rate of increase in houses has slowed down, peaked. But then again, as soon as rates come down, people are going to rush back into the market and probably drive prices back up because, again, supply and demand are not in equilibrium. We have less supply than we have demand for houses. So the greater the demand, the higher the price is going to go.
How does it impact the bond market?
That's a great question. When interest rates go up, bond prices go down. So, for example, if you paid $1,000 for a 4% bond this month, and 3 months from now, you could get a 6% bond for $1,000. Do you think somebody buy your 4% bond for $1,000? No, because if rates go up, bond values go down, principal values go down. Last year, 2022, we saw for the sixth time in a long time, close to 100 years, where stock prices and bond prices went down. Now, bonds are generally considered to be ballast in a portfolio, meaning if stocks go down, bonds go up, but that's not always the case. And last year we saw that.
And that's rare, right? You don't see that very often.
Correct. But here's the good news in all of this. As people are more conservative in their investing, they generally have more bonds in their portfolio, generally. And so when you have bonds in your portfolio for the last 10 years, bonds have not been paying that much. So people weren't really getting rewarded or compensated for the risk that they were taking. And now that bond prices have come back in line, bond yields, put it that way, interest rates have come back in line with long-term averages, people who are investors in bonds are actually getting some sort of return on their investment, some sort of compensation for the risk that they're taking. So because bonds have become more affordable, they are competing somewhat, not directly, but competing somewhat for investment dollars in pension plans and people's retirement accounts. So that's really what's happened over the past year. And it's probably a good thing, because the Federal Reserve has been the 800-pound gorilla and really sat on interest rates for a long time. And now that rates are going up and starting to normalize, it's making bonds a more palatable investment for many people.
Now they've if we have another minute, I have a question here. So they paused, but now they're talking about they might raise it up another quarter. If they don't raise it up another quarter, what will that have? What will that impact have to? What impact will that have on the bond market?
Well, that's a great question, and I think the markets have been anticipating a pause, if you will, or a peak. And generally speaking, when the economy heats up, the Fed raises interest rates to slow it down. And when the economy slows down, the Fed drops interest rates to speed it up. Well, if the Fed is pausing, that would be an indicator that they see risk of recession in the future. We've been talking about that for years. This is the most anticipated recession that never happened. Well, if the Fed does pause, I think that means that we're probably going to see more buying in bonds, certainly at the longer end of the curve, meaning longer duration bonds, because as interest rates go down, bond prices go up.
Yep.
Just the opposite of when interest rates go up, bond prices go down. When interest rates go down, bond prices go up. And if we're starting to go into an easing cycle again, people are going to see their bond values go up.
Very exciting stuff.
Yeah. Well, if you have a question, we actually got a question from Mars Nance of Boston, or Mark Nance. I hope I got that right. How does a reverse mortgage work? Can you help us with that, Ken?
Absolutely. So reverse mortgage, also known as a home equity conversion mortgage, or a HECM, it's typically for retirees who have built a significant amount of equity in their home over the years of paying their mortgage off, and maybe they have a house that's worth $600,000, and maybe they don't owe anything on it or owe very little. A reverse mortgage is a vehicle that allows them to slowly take equity out of their house over a period of time as income. And it's a phenomenal tool for those who are of retirement age that have a lot of equity in their home. It can be a little bit expensive, but in comparison to other avenues, it is a relatively easy way to have monthly income. You might have your Social Security, you might have some dividends, you might have a pension. But if you have a lot of equity in the home, then you can essentially convert that equity into either a lump sum with no payments, or a monthly payment in the form of income. It's backed by the Federal Housing Administration, and can be a very. You just make sure that two things: you want to keep an eye on the costs. Make sure you're not being charged too much. And an interest rate is a little bit more expensive from an interest rate perspective. But all in all, it can be a powerful vehicle in retirement.
Good to know. Thanks for your question, Mark. If you have a question, here's how you can send your question to Money Matters TV.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says Send Us Your Questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, MONEY, -matters, MATTERS, TV.com.
Well, throughout the beginning of this show, we've been talking about interest rates, mortgages, debt, and because oftentimes it's something that's unavoidable. But it's very important for the next generation of Americans and investors to understand what that is. Today, our guest is Gregg Murset, who's a CFP and CEO of Busy Kids, a program which he started to teach kids financial literacy. And we think it's pretty interesting. How you doing, Gregg?
Doing good. How are you, Doug?
Fantastic, thanks. You know, I was checking out your business. It looks pretty interesting, and that you, the company you started, offers credit and debit cards to kids. Is that right?
So we don't offer credit cards, but we offer a debit card, and we offer that debit card so they can start understanding how money works that you can't see. Because nowadays we don't carry around cash in our pockets. For heaven's sakes, we're not going to carry around coins, right? And so how do you teach the next generation about money when the nature of money has changed so drastically? So that's what we're trying to do, and we're doing it with the debit card.
That's fantastic.
I thought you were going to say you're giving car loans to 8-year-olds, so I'm glad to hear it's just a debit card there.
No, we're helping them save up for a car one day, but a beater, not a real nice car. I believe that a kid should have a junker to begin with.
I agree. Until they learn how to take care of it, right?
Yeah, there you go. They have to break down once in a while and stall and those kinds of things. They give character to a kid, right?
I couldn't agree more. But what are some of the pitfalls, Gregg, what are some of the dangers of giving a younger person a debit card?
Well, I think number one, the first pitfall is they don't realize what it's actually doing. So I think it's really important that kids get the connection between working and money right out of the gate. And I've searched high and low, and I've tried to find a job where you can go do nothing and still get paid. And I haven't found it yet. Okay. So what you need to do is teach them that connection between work and money. And I think the best place to do it is at your house. It's like a perfect little ecosystem to teach them about this. So give them some chores, let them bust it out, earn some money, scooping up dog poop and washing the car and trimming the tree, do whatever, cleaning the closet out. Give them stuff to do, let them earn some money. And then they can start having experiences with money. Kids learn best by doing stuff. And when you can give them a card so that they can start understanding, oh my goodness, I swiped that card or I stuck it in that machine at the grocery store or at the other store that I went to, and now the numbers on the screen changed. Like, oh, that's what money does. And you have to give them those visceral experiences so that they can start understanding this stuff. And a card's a great way because that's how all of us do it. And even more, you can link it to their phone and, let them learn. I tapped my phone. And, man, my 2 weeks of poop scooping is gone. That's an important thing to learn at a really young age for a kid.
I'm glad you brought that up with the chores, because I can remember as a kid doing almost all of those things that you mentioned.
In order
to earn an allowance. In order to earn an allowance and also, working in restaurants and, running businesses, lemonade stands, but everything was cash. And now in a digital society, everything is credit or invisible money. And so it's really, when it's tangible, when you can see it, it's a lot different than when it's on a card. And certainly with kids playing with smartphones, to be able to see, what they have, how they spent it. And I mean, I think that's an important and valuable lesson for them to be able to make that connection.
Yeah, and I get the argument about, well, it's, you got to have physical money in your hand so it hurts more, right? I get it, and it does hurt more, and I think that there's some validity to all of that. But very quickly, that becomes inconvenient, okay? It just becomes annoying that you got to bring around this big wad of cash, and you got change all the time, and it's just. And if you go, on an airplane, they don't even take cash. So in other places, it's becoming more and more a cashless society every day. So we got to kind of, change gears. We got to start teaching them the reality in which they live. And that is invisible money, digital money. So absolutely, that's the way to teach them.
So what's an appropriate age to start teaching them about or giving them a debit card? But more importantly, at what age do you give them a credit card? Do they go out and get their own credit card? Do you give them a credit card that has your name on it? What are your thoughts in that area?
Yeah, I'd say start young, really young. Start them understanding this concept of money when they're 5 or 6 years old. I know it sounds really young, but they're smart. They'll get it quick. And let them build over time. The old adage, practice makes perfect. It does, right? It does. It works on the piano, the violin, baseball. It also works with money. So give them lots and lots of experiences so that they can start having those experiences and learning from them. And they're going to make some really dumb mistakes, right? You're going to be oh, I got to have those Nike shoes. They're so important to me. And they're $145. And then they're going to get them, and then they're going to think, I don't know if that was worth it. That's a lot of money, and I had to work really hard for it. That's a good lesson to learn, even though it was maybe a bad decision. So let them do all that. When it comes to a credit card, good grief. I mean, that's not going to be till they're 16, 17 years old. That's when they need to start learning that stuff. And the hope, I would say, is once they get to that age, if you've been doing what I'm trying to say here and teaching them along the way, they're not going to fall into all the traps of the credit cards, which is essentially getting on the treadmill of interest, right? They're not going to get there. They're not going to go there because they know better. If they use it for convenience or they use it, I know some people are totally against the miles thing, and you get points and you can redeem them for hotels and all that. Okay, if you want to do that, great. If you got the ability to manage that stuff and pay attention to it all, super. Do it, but make sure you pay them off every month and you're not paying any interest to that credit card company.
Yeah, no, that's a really good point, particularly the point of getting them early and teaching them, because once they become, until they're while they're under 18, if I'm not mistaken, credit card companies won't lend to them because obviously you can't be held liable as a minor.
Right. Yeah, but
but as soon as they're in college, they get inundated with credit card offers. And I can remember kids that I went to college with, either at school or after graduating, racking up all kinds of debt because these banks were giving away credit cards even when you didn't have a job. So what's the best way to introduce that to kids at a much younger age?
Well, like I said, I would use, obviously VisiKids, what we've done is we've tried to create that ecosystem where people can have this experience early, right? And you got to teach them, I think, what we call a balanced financial approach. If you're just teaching a kid to earn it and burn it all, you're not teaching them anything other than that's what most Americans do. But we need to teach them a balanced financial approach where you earn money, and that's good. But what do you do with it after that? You gotta teach them, okay, you gotta save and invest a little bit of it. You gotta share some of it so you can understand that the world is a bigger place than just you, right? Give some to charity, church, I don't know, something you care about. And then you spend the rest and you spend it responsibly and you do it digitally. That balanced financial approach is really the underpinnings of a responsible person when it comes to money. If you're just facilitating an easier way to spend, you are undermining the ability of that kid to learn a responsible way of dealing with their money. So I would say balanced financial approach every time you earn money. If you can do that every time, watch out. I have 6 kids, believe it or not, 5 of which have left the nest, okay? And all 5 of them who have left have had more than $10,000 saved up before they left. And I'm telling you, it's not because I'm paying them $200 to wash the car, okay? This is just, if you start them early and you teach these fundamental things, like a balanced financial approach, they get it. And they're smarter and they get better at it as time goes on, because practice makes perfect.
So money managing is borrowing is a portion, is a part of money managing. And a lot of the concepts you're talking about here are managing the money that you have. Borrowing is managing money you don't yet have. And I know now as a country, we're now over $1 trillion in debt. In credit card.
I had to Google how many zeros that was, and now I can't remember how many.
It's a lot.
It's a lot of zeros, like super. What did it say? Like 1,000 billions, or I don't know. I think it was 1,000 billions is a trillion, and it's just like mind blowing stuff, right? Who even knows? It's just ridiculous. And so, and that all goes back to behavior. Let's be real, right? It's spending more than you got. It's just overextending. It's letting your wants override everything, and this is a big problem, and that's going to come back to get us. $1 trillion is so significant. We better wake up.
What can families do to help lower their debt right now?
Oh, like I said, I think it's all about behavior, right? If you look at it, if you think about how can we save money as a family, or maybe not spend so much and go in the hole, right? I think a couple of things come right up into my face. Number one is eating out. I mean, eating out is a very expensive proposition, especially if you've got a number of people in your family, right? I think one of the best things you can do with kids is be more transparent with them about how much stuff costs. So next time you go to the restaurant and the bill comes, right? I think this is a great opportunity to say, hey, come over here and let me show you the receipt. Why don't you help me figure out what the tip is and all of that stuff. And then you're going to see your family's eyes go big when they're like, holy smokes, it cost us $126 to eat dinner tonight. Like, that's a lot of money. And if people would kind of figure that out, be more transparent about it, you could literally spend $20 at home and take the other 100 and pay down your credit card. Like, that is I think that's one of the real biggies that people get tripped up in. They love it. I get it. I love to go out to eat too. I love not doing the dishes. I love having somebody else make it. But it's a big trap when it comes to overextending our finances.
No, that's a really good point. To be able to put that in perspective for your kids, that when you do go out to dinner, particularly if you have 5 of them
Exactly.
at the table, what the actual cost is. I had a friend who used to do that every once in a while. He'd take people out to dinner and play credit card roulette when the bill came, and jokingly have people put their credit card in a hat and pull one out and say, well, you're going to pay for it tonight. Well, that kept people pretty honest about not going overboard on their bill. But
I like that. That's a good idea. I'm going to do that with my kids next time I go out.
Yeah. Well, since you're
grown, so it might work.
Since you're giving them debit cards, that'll really put it in perspective. Another, just to comment on some other everyday activities. As an advisor, I used to take my kids to the grocery store, and I would help them understand what the labeling on products means, whether it's the dollar price for the box of crackers and what it was per pound, so that they could effectively compare what one box costs to another. Other groceries, produce. Being able to go through the grocery store, I think, is a great learning experience for kids, because then they get to decide, well, do I really want that piece of candy? If it's not going to have nutritional value and it's just going to cost money. So
Boy, I bet you they were lining up to go to the store with you. That sounds like a blast. Like, man, I can't milk Dad for anything. Plus, he's gonna, teach me all this stuff. Oh,
Yeah.
fun times, fun times.
Yeah. Hopefully it worked. We'll find out. So, do you have any other suggestions for our viewers on how to teach their kids to be money smart?
Yeah, I think on that vein of transparency, I think another one. We live in Phoenix, right? So it's hotter than heck all summer long, and you can imagine what the electric bill is for air conditioning, right? And so I think that's another good one. Next time you're just sitting on the couch with your kid and your phone buzzes, and oh boy, here comes the electric bill. This is a great opportunity to say, hey, why don't you come over here? I want to show you how I pay the electric bill every month. And their eyes are gonna pop when they see that, and they're like, it cost $450 to like air condition our house last month. That's more than I've made in 3 months, right? So this is a great opportunity to just expose them to some of these things. You can do that on the couch with the electric bill. You can do that at the gas station next time you go, where you tell them, you know what, not only are we putting $57 in the car, but you know how much these tires cost? These tires cost $1,000 when they need to be replaced, and they need to be replaced every 2 years. Like, just to start exposing them to like these very basic things that we think are no big deal, but they are going to really have a big impact on your kid, and it's going to change the way they think about money.
Are there any apps, any of your favorite apps or tools, websites, resources that you recommend?
Well, of course, I always recommend my own. That's Busy Kid. I always say, get your kid being busy with stuff that actually matters. Instead of them sitting on their phone and scrolling, Instagram and watching endless amounts of reels and other things, get them using technology in a way that will be helpful for them into the future. Let them use something that teaches them these really valuable life skills. After you teach your kids how to, not to steal and beat people up, you got to teach them about money, because they're going to make financial decisions literally every single day of their lives. Use technology to do it. It's where it's at, and it's not going anywhere. That's for sure.
Well, I know you're going to know if your kids picked up on all those good values when they start turning the thermostat up in the middle of summer.
Closing the doors, turning off the lights, cranking
exactly.
the thermostat up. They're going to be completely paranoid. It's going to be great.
Well, Gregg, this has been a fantastic discussion, and I think the concept is great. Certainly something that's valuable for the next generation of Americans, particularly in a country that has as much debt as we do. So thanks for coming on today. And
thank you.
I want to thank you, Ken, for being a co-host. And also I want to thank the viewers for watching Money Matters TV, because at Money Matters TV, your money matters. Our next guest is going to be Nick Imbezi of the Chester County Food Bank. So stay tuned for that, and have a great day.